a little bit more interestingly to direct questions as opposed to just rambling off. So right off the top, disclosure statement. Everyone's tax situation is unique to themselves. There are multiple different things that can impact your taxes. Anything that is said here is not a guarantee of any sort of tax advising for your specific situation. Always talk to a qualified tax professional about the nuances of your situation. So, Argit Tax Group, we are crypto-specific tax planning. We've done everything from individual tax planning to reduce overall tax liability to working with small businesses, working with ICOs. We've been in business since 2015. We actually got our start working with truck drivers, which most people don't realize that the tax law specifically for those under hours of service regulations, there's a bunch of different codes that don't apply to the average person that only apply to truck drivers. So we really got into looking at nuanced parts of the tax code, being able to read and interpret, looking at precedents set through the tax courts. I've personally been in taxes for over half a decade, and I've been specifically involved in crypto, and our main focus now is crypto, for 3 years. I have a background in tax resolution, which when you hear those late night commercials, if you owe $10,000 or more to the IRS, give us a call. That's tax resolution. So we know how the IRS operates on the back end from an administrative standpoint. Before you even get to tax court, there are about 14 different steps that you can go through to fight your case without having to see the inside of a courtroom. We do consulting, and then obviously we do tax preparation as well. And we personally, and I mean my wife and I, we invest in crypto. We've done crypto-backed loans, we've done mining, and we've done consulting on ICOs and other crypto projects. We try to stay on the bleeding edge. I am a very firm believer that if you are not involved in an industry that is so nuanced like cryptocurrency and constantly changing, you can't really comment on it. I've seen too many CPAs or had clients come to me and say, well, I talked to my CPA and he claimed he knew what he was doing with crypto, and his experience is, well, my grandson gave me $25 worth of Bitcoin at Christmas. Well, okay, well, you don't know if you're on KuCoin or Binance. Do you need to be filing an FBAR disclosure? Do you need to be tracking basis in certain situations? If you have a hard fork, what does that mean for your taxes? These are questions that if your tax preparer doesn't know can actually cost you quite a bit of money. And I'm also what's known as an IRS enrolled agent. So I'm not a CPA. CPAs are licensed by the state. My certifications come from the IRS directly. I've taken 3 different tests in individual tax law, business tax law, and then ethics and representation. I have the same rights as a CPA in front of the IRS. The only thing that I can't do that a CPA or a lawyer does is certify financial statements for publicly traded companies. It's just not my cup of tea. If you want that, get a Fortune 500 CPA and you'll be good to go. But most people would rather have someone who is wrist deep in the tax law, especially when it comes to something that's not necessarily super clear. So, as we all know, the IRS is on the bleeding edge and always keeping up with really great advising. The only thing that they have talked about as it relates to cryptocurrency is tax notice 2014-21. It is about 4 pages long, and it outlines that cryptocurrency is property and a couple other small things, but leaves things wide open. So there's a little bit of a discussion before we got started here about like-kind exchange in crypto. Well, if it's technically designated property, does it fall? The IRS has been completely silent on that issue. We have to look at other statutes, other proceedings, and other tax cases to see whether or not we could actually formulate an argument that like-kind exchange is allowed. Like I said, it's property. In some cases, it can be treated as a security depending on how the token operates, whether or not the SEC has ruled on it, and there's a whole host of different rules and regulations that come into play when we start talking about securities as well. One of those is wash sale, and we'll talk about that when we talk about loss harvesting. And then there's no one organization that really has jurisdiction over all cryptos in the United States. Right now, the big 3 are the SEC, the CFTC, and the IRS. They all do different things. They're all kind of jockeying for who's going to be the top dog in that, and I'll be very curious to see who wins that fight. But as of right now, all 3 of those are effectively crippled with the shutdown. So now that's one thing I want to clarify about the shutdown. If I see one more meme about, hey, the IRS is shut down, file your tax return, get away with things. If you think that is a viable strategy, please talk to a tax professional. They will come back and get you. So, generally speaking, crypto transactions have capital gains somehow worked into them. In a pure investment standpoint, if you buy a cryptocurrency, you establish your basis for what the price that you buy it, any fees get added into that basis, and when you turn around and sell that cryptocurrency, we subtract the basis plus fees, and that's your total profit. When we start to look at how the crypto is actually acquired, that can change the tax structure, but there will almost always be either a capital gain or a capital loss. The way that we start looking at how we acquire the crypto can add in self-employment tax, other income taxes, and even payroll taxes for those of you that are getting paid as an employee in cryptocurrency. Generally speaking, payroll is really only applied to the companies, not necessarily the individuals, but we'll get into that in a second. So, like-kind exchange. As of 2018, with the tax law updates, like-kind exchange is 100% dead for anything that is not real estate. So no more trading cars for cars, no more trading cryptos for cryptos. I am of the opinion, because most people don't file the paperwork, that form, the 8824, for every transaction that you have for crypto that you have to claim, or you want to claim like-kind exchange, you have to fill that out. So if you've got 2,000 transactions and you're claiming like-kind exchange for all of your crypto-to-crypto transactions, if you don't have 1,000 8824s, that's the first thing the IRS is going to look at in your court case to determine whether or not you were in compliance or acting in goodwill.
Mail it to them.
Exactly. Most tax professionals, and we usually have to fill those out by hand. The savings that you would save on your taxes in some cases for doing like-kind exchange, I'm going to end up charging you for filling out 1,000 8824s. It's not like Michael Scott's bankruptcy, running around screaming, "I declare bankruptcy." It's not how like-kind exchange works. You can't do that retroactively. You have to amend the return and file all the paperwork. Also, when you look at the specific nuanced rules for like-kind exchange within Section 1031, they disallow like-kind for inventory or stock in trade, stocks, bonds, or notes, other securities or debts, partnership interests, or certificates of trust. When we start to look at what crypto behaves more like, is it more like a car, or is it more like stocks, bonds, notes, securities, or other debts? That is probably one of the bigger nails in the coffin. But the other thing too that I look at when I try to formulate a case here is, what does the IRS do for trading gold for silver, or silver for platinum, or something along those lines? There have been specific revenue rulings that have been in place since the 80s that state the only time that you can use like-kind exchange for precious metals is if you are going from a gold bar to an American gold coin of the same purity. You cannot trade silver for gold, gold for platinum, copper for gold, and expect like-kind exchange treatment. So based on that, if we were to sit in front of a 70-year-old federal judge who doesn't understand what blockchain is, and we're trying to explain, well, it's not just an investment vehicle, it's also got this use, precious metals are probably the best analogy we can make, and based on these facts, there's no way that we can claim like-kind exchange. You can go ahead and claim it, and I've seen a handful of articles that say, well, hey, if you get into trouble with the IRS, here's how you go about fighting your case. And they're right to a point. The issue that most people don't realize is if you were to claim like-kind exchange, let's say you got really lucky and you had $1 million worth of capital gains that you're deferring through like-kind exchange. If the IRS goes back and unwinds your argument and proves that you cannot claim like-kind exchange for crypto, not only are you going to owe all of the underpayment penalties plus interest, they're going to hit you with a substantial understatement of tax liability, and that's another 20% of the tax owed. Now, I tell all of my clients, if the courts rule in the next 3 years that like-kind exchanges for crypto, I will put on, Eye of the Tiger, slam some Red Bulls, and we'll go back and we'll amend your returns. But that 20% penalty for a lot of the larger clients doesn't make sense to take that unnecessary risk, especially when we don't have a defensible position. And this is straight from that revenue notice, specifically about cryptocurrency. And the revenue department typically doesn't pick and choose words lightly. When they specifically reference stocks, bonds, and other investment properties are generally capital assets, it kind of tips their hand a little bit as to how they're going to look at that. Now, once again, this is really only from 2017 and back. So if you're going to amend returns, you've got 3 years to do that from the date of filing. 2018 is completely dead and gone with the Tax Cuts and Jobs Act updates. So now that we've gotten all the fun hope dashed, like we said before, when you just buy Ethereum, you set your basis. We add a processing cost, a fee of $1. His basis is now $101. 11 months later, he's going to turn around and sell that Ethereum for $200 with a processing cost of $2. One thing to keep in mind is anytime you have a capital gain, if it's any period under 1 year and 1 day, you're going to have a short-term capital gain versus having a long-term capital gain. Long-term capital gains are almost always preferable to short-term capital gains because the tax rates for long-term go anywhere from 0 to 20%. It's in 3 brackets. So it's 0, 15, and 20%. If you're married filing joint, you can actually cash out long-term capital gains to the tune of $75,000 and pay 0% capital gains tax. The IRS does this because they want to incentivize you not to just be turning over investments. They want you to hold for the long term. Short-term tax rates match your ordinary income tax rates, and that's anywhere from 10 to 37%. Once you start getting into higher amounts, they'll actually hit you with what's called the net income investment tax, which is a bonus tax of 3.8%. So it's one of those things when we start looking at portfolios, especially if you've got some flexibility and you're not just day trading insane amounts of crypto, or if you're one of those lucky few on BitMEX, structuring that income specifically, choosing the accounting period can actually make a huge impact on your taxes. So when we look at that, is anyone feeling brave to want to guess how much profit was actually in that transaction of $100 with a $1 processing cost and then selling it for $200 with a $2 processing cost? We have a winner. You're actually the first one at any of these events to get that right. And that's like 4 different conferences. So because it's a short-term capital gain, he's going to have a 15% ordinary income tax bracket, or he's in the 15% ordinary tax bracket. So he's going to have taxes of $14.55 on that $97. If he would have waited 1 month more, being in that same bracket, he would actually have 0% long-term capital gains. So sometimes patience is key.
And that was because he was filing jointly or something?
No, so the jointly is a separate issue. We have different brackets for the different filing statuses. So single filers have a different bracket than head of household, then married filing jointly, then married filing separate. But the idea is depending on what income bracket you're in determines your long-term capital gains rate. So it's not, short-term is, if you're in the 10%, you're in the 10% for short-term. If you're in the 37%, you're in the 37% for short-term. When you switch to long-term, if you're in the 10% bracket or 15%, I think it's 10 to 15% for short-term, you're in the 0% long-term capital gains bracket.
He's in the 0 bracket for long-term.
Correct. So we mentioned earlier, depending on how you come into your cryptocurrency can change the tax structure. So if Eddie's actually an independent contractor, he's a web designer, and he gets paid in Ethereum instead of in fiat cash, he's going to recognize the fair market value at time of receipt. So if he gets paid in $2,000 worth of Ethereum, he's going to have $2,000 of gross income. He's got expenses between his cell phone, his laptop, maybe he likes to go to Ozo Coffee and meet clients. He's got total expenses of $1,900. So he's going to recognize a profit of $100, and on that profit he's going to pay income tax and self-employment tax. His basis is now $2,000 because that's what he recognized the income as. So if he holds onto that crypto and turns around and sells it a month later for $2,500, he's actually only got a capital gain of $2,500. We're not basing his basis on what the actual profit was from his business. We're basing it on what he recorded it as he received it. So this has been probably the hottest topic. I'm sure everyone's feeling real good about the portfolios compared to the beginning of 2018 to current. Capital loss rules. So capital loss operates different than ordinary business loss. There is no limit to, I should say, there is a limit based on certain circumstances if your income phases you out. But generally speaking, there's no limit to the amount of business loss that you can take. So if you're that web designer and you lose $10,000, but you've got, W-2 work somewhere else, you can take that $10,000 loss and apply it against that other income and pay taxes only on $20,000. So $30,000 of W-2 income, $10,000 of loss. Taxable income is actually only $20,000 before we start factoring in standard deduction, things like that. When you have capital losses in excess of your capital gains, so let's say your portfolio, your Bitcoin lost $10,000, your Ethereum actually gained you $2,000. You take the capital gains, subtract out the losses, you'd have $8,000 worth of loss left. You can only take $3,000 of capital loss against other ordinary income. So if you've got that same web developer that's got $30,000 of salary, he can only take $3,000 of loss against that salary, and the remaining $5,000 carries over to the next year to offset capital gains, or they'll pull another $3,000 chunk out. There are some customers that I have, and I'm not going to name any names, that they have close to $150,000 worth of capital loss that they are not going to be able to really reap the benefit of because they're not planning on trading any more capital gains items. It's going to take them 50 years to pull all of the value of that capital loss out. And they're a little bit older, so they're probably not going to be around to really be able to utilize that. There's a lot of questions surrounding capital loss. If I'm an active trader and this is my livelihood, can I treat this as ordinary income and therefore ordinary loss and take it against other incomes? There are some cases where that can happen, but it's very, very, very specific in who can and can't do that. So if you have those questions, I'd be happy to entertain those a little bit later. We can talk about your specific situation. Like I said, the loss will get carried forward to the next year and the next year and the next year and the next year. And the sad thing, honestly, is if you're an individual that's a corporation and you're trading through a corporation instead, you can actually carry that loss back 2 years and then carry it forward the remainder. So those people that had really great gains in 2017 that were trading all over the place that then whittled the portfolio down to nothing, if you're an individual, that doesn't carry backwards. It only carries forwards. So you're still going to have a tax liability, and you're going to have some issues with the losses just rolling forward over and over and over again. And the other thing to remember too is the losses retain the same character. So if it's a short-term loss, it's going to get applied to short-term gains first and then long-term capital gains. So if you have the opportunity to structure your losses, you always want to try and shoot for short-term losses, because remember, on average, short-term gain tax rates are significantly higher than long-term capital gains rates. So if we can get more short-term loss, it'll go against your short-term gains first and then against your long-term capital gains. And that's very important to remember when you're picking your accounting methodology as well, when you're doing your accounting for the end of the year. Payroll with crypto, if you are getting paid in Bitcoin instead of fiat cash, it's just like being paid as an independent contractor. The day that you receive that, that's the basis for that token, regardless of what taxes are taken out or other withholdings you have. So if you get paid with $1,000 worth of Bitcoin, and $1,000 worth of Bitcoin hits your account, your basis in that Bitcoin is $1,000. The employer will still be responsible for withholding the employee portion for income tax, and also for payroll taxes, your Medicare, your Social Security, things like that normally come out with any other paycheck, get remitted to the IRS, and the IRS obviously isn't taking cryptocurrency, so your employer will actually have to sell that cryptocurrency and then report to you on a W-2 what they paid you in fiat dollars, not, hey, your W-2 just says I have 50 Bitcoin. It's going to say you got paid $53,000, and you have to actually go back and figure out what your basis in that crypto was to determine whether or not you had a gain or a loss when you sold it to actually get fiat back out. So as someone who takes crypto in payments along with fiat cash, it's a really great way to earn crypto. It has opened up some new markets, obviously. We diversified from truckers into crypto. But the idea being, if you can actually get paid in cryptocurrency, generally speaking, the fees are a lot lower. Two, in a bull market, we did a lot of actually consulting at the end of 2017, helping structure based on the tax law updates. There were some things that were going to close off in 2018 that we were able to structure. We got paid on December 2nd in Ethereum. We let it ride for about 2 weeks. We took a portion of it out and we collected those capital gains. We waited till December 31st. We took a little bit more out, got those capital gains, and then we waited into the next year. And now we're paying taxes on capital gains that we got on January 1st of 2018. If you're a business that can weather the volatility, it's not a bad idea to be taking payments in crypto, because there is that chance for upside as well as lower fees. If you're concerned about that, look at a stablecoin like DAI. There's plenty of solid stablecoins out there that would allow the ease of transaction without having to have that volatility, but it's a really great way to start building assets if you've got that ability to bring on clients in that. There are a ton of benefits for independent contractors. So one of the big ones in the tax law updates is the 199A, which basically states as long as you don't go over a certain amount of income, you get a 20% deduction for qualified business income. So if you've got $100,000, you get a $20,000 business expense essentially that will be applied against your taxable income before they charge you a tax rate. So we did the numbers between 17 and 18. Our income doubled, and our marginal tax rate, so the tax we pay on every dollar, jumped up about 7 percentage points. But because of that 199A, our effective tax rate, so if we look at every bracket that we're in, actually dropped 0.5%. So we're paying less taxes on more money because of the Tax Cuts and Jobs Act, because of our restructuring. Because I'm self-employed, yes. And that's.
So it's not like you're not selling a product, for example. You're just contracting time.
So either selling a product, anything that you're doing that you are your own employer, whether it's selling a product, selling a service, selling educational courses, Uber driver, any of that is all going to fall under the qualified business income. And that's any kind of partnerships, sole proprietorships, S corps. The only entity type that it does not apply to is C corps.
And what is the rate?
You get a 20% deduction So if you have $100,000 worth of profit, you're going to get a $20,000 deduction against that $100,000 without having to spend a single cent to recognize that. Because usually when you have a business expense, you have to go buy a phone or buy a depreciating asset and accelerate that. Any dollar that you spend on a business expense is usually only anywhere from 15 to 40% on that dollar you're going to save in taxes. This is pure dollar for dollar without having to spend a single cent.
What year did that start?
That starts in this year, in 2018.
This year.
Okay. Is that in addition to the things like the regular deduction, the $12,000 deduction?
Yes, yes. And for a married filing couple or married filing joint couple, it's $24,000. So, it can really stack very, very quickly. One other thing that I've seen a lot of too, ICO activity is getting a little bit smarter. It's not just firing out white papers and trying to raise $300 million. They're starting to look more and more at doing actual security token raises. One thing to keep in mind, if you're a contractor and getting paid in tokens that have a lockup period, you can actually make an 83B election just like you would with any kind of stock for working for a startup. So what the 83B election is saying, I want to pay the taxes on the date that I sign my agreement, and my tokens are worth, half a cent each. My lockup period's for a year. Once I sign that agreement for the 83B and pay those taxes on it, now it shifts to a capital asset. I have a lower basis in my tokens, but it starts the counter for capital gains. So if I know I have a 1-year lockup on my tokens, instead of receiving those tokens a year from now and having to pay whatever the fair market value is as ordinary income, I can sell them for capital gains instead. So if you've got any sort of offers like that where you've got a vesting schedule on tokens, talk to a tax professional the second that you get that offer, because there's a lot of things that we can do to save some money. So I've got some other clients that came to me too late, and we can't retroactively make this 83B election because you have to make it 30 days from your offer letter. The tokens at the time would have been worth about $20,000 if they would have paid the taxes on it in 2017. The tokens now are worth $4 million. So because they didn't make the election in 2017, they now have to pay taxes on $4 million worth of tokens coming to them. Ordinary income tax, not capital gains. So it makes a huge difference when we start looking at being able to make elections and making sure that we're doing those timely. And also, if there's any rare exception where you're actually still able to mine and make a profit, which most people I think are either break even or losing significant amounts of money, mining is actually considered self-employment income because you're putting in effort to receive tokens. Just like getting paid in tokens, we subtract out the expenses, we figure out the self-employment tax, and then you also set your basis when you receive those tokens. And anyone that gets paid in tokens for work in excess of $600 is supposed to be getting a 1099 from that employer showing that they did receive payment in tokens, but just like the W-2, it's not going to show the number of tokens that you received. It's only going to show the dollar amount of the tokens at the time of transfer. I emphasize you should be getting those. I think a lot of people are still catching up to that kind of payment structuring and those needs as contractors.
Where does the $600 figure come from?
That's the IRS statute of limitation is anything under $600, there's no requirement to issue a 1099 to a contractor. ICOs, I'll just touch on these real briefly because it's a constantly changing issue. Like we said before, giving the awards to the contractors can have some significant tax implications for both them and for the business. If you think you're going to do a utility raise and sell utility tokens and not claim those as income, there were a couple of us talking about that earlier before this started. Any kind of utility token sale is going to be treated as a sale of a good, and so you're going to have income from that. Whereas a security token raise, you could make the argument that it's an equity raise, and equity raises are not taxable for income tax. The other thing too is after the decision out of the Supreme Court of Wayfair versus South Dakota, there are 13 states that charge sales tax on software as a service. If you're selling a utility token, it's going to be really hard to not make the claim that you're software as a service, and you're going to owe sales tax in those jurisdictions if you've sold any tokens to residents of those jurisdictions. So those sly ICOs that thought that they could just run and gun and claim they're a utility token but not pay any of the taxes are going to end up getting squeezed by both the state, the federal, and the SEC, all wanting a piece of the pie of which one are you actually. And if you're going to have to pay income tax on $300 million and your war chest is now only worth $3 million, it's going to be a really, really rough season. Gifting, you can gift tokens to family members, friends, really anybody. The limitation that you want to try and keep in mind, if you ever think your estate's going to be worth more than $11 million between you and a spouse to give to your offspring, you want to keep it to a tight $15,000 of value. The reason being is every dollar after that $15,000 chips away at your lifetime gift exemption. So when you die, the IRS says that you can give away up to, I think, 5.6 million right now with the Tax Cuts and Jobs Act to an individual. So if you're a single individual and you've got a kid, you can give them 5.6 million, no estate taxes on that money. If you give them 5.6 million in excess of 15,000, that wipes that number down to zero. So if you and a spouse are able to give to, your son and his wife, we can start playing around with those numbers, but something to keep in mind because those estate taxes get pretty hefty pretty quick. And there's a lot of things that, if you're investing for the long term and you're expecting your bags to go to the moon, and Bitcoin, for John McAfee's sake, let's hope gets to, $100,000 by the end of 2020.
You changed it to $1 million.
Only $1 million? 5 Bitcoin gets you pretty close to that lifetime limitation. So for those of you that want to start thinking about, leaving an estate behind or even gifting to kids for college or other family members to share the wealth, you want to be very, very careful about those gifting limitations. And then anything that someone receives property-wise from you while you are still living, they get your basis in the cryptocurrency. So if you bought it for $100, when you give it to them, it's worth $200. Their basis is $100. If you die, they get what's called step-up basis. So if you die, you leave the estate behind, it goes to your individuals, your heirs. Whatever the fair market value of that crypto at the time of your death is, that's what the basis becomes. So in some cases, it's better to wait to just pass on instead of just giving out property willy-nilly.
And if you're down, you would wait?
Do those limits apply like an LLC?
So it would depend on the structure of the LLC. If the LLC is meant to last beyond the shareholders, if it's a sole member LLC, there wouldn't be any kind of estates. It would flow back through to the individual. So all the pass-throughs, you're usually going to have all the assets come back through. You can gift shares of stock and change the operating agreements, but we'd want to talk probably a little bit more specifically surrounding that. One of the things that makes me incredibly sad about the fact that the bull run did not continue at the end of 2017 or early on in 2018 is the qualified opportunity zones. So within the Tax Cuts and Jobs Act, tax law updates, there's a provision called qualified opportunity zones that allow you to defer capital gains until 2026, provided that you invest those capital gains into a business or a piece of real estate in a designated basically economic area. It's all based on 2010 data. So I'm based up in Longmont. Almost the entirety of downtown Longmont falls under a qualified opportunity zone. So if you're opening up a startup and looking to fundraise and want to be a tax advantaged business, if the bulk of your assets are located within an office space within a qualified opportunity zone, you qualify as a qualified opportunity zone investment. And that's anyone who's a investor or even a founder can contribute capital gains items in. You have 180 days from the date of sale of those assets to contribute those in. If those assets were held in an LLC that's a pass-through, your 180-day counter starts January 1st of this year, or the year that you received the K-1. So for those of you that have been trading through entities, that's a really great way to be able to defer those gains further on and potentially borrow for projects and build up and out. They look at the dollar value, not the actual source of the money, but you have to have capital gains in order to take advantage of this. Like I said, you have to invest in either business, real estate that you improve, or funds that invest in either one of those options. And the longer that you hold those investments in the QOZ, after 5 years, they give you a 10% bump in your basis because you're going to be paying those taxes in 2026. After 7 years, you get an additional 5%, so your basis jumps up 15%. And then after 10 years of being in a qualified opportunity zone, and this goes out until I think 2046, every 10 years that you have that property in there, the fair market value of that property becomes the basis. So if you've got real estate in a high growth area, and let's just say you buy a building in Boulder, you knock the building down, you improve it 100% of the value of the building that you bought, and you sit on it for the next 10 years, you could turn around and sell that building for $0 worth of capital gains because you'd be at fair market value. So there's a lot of different opportunities for starting an accelerator in say Longmont. There's even some opportunity zones here in Boulder. There's a bunch all over Denver. The bulk of Detroit is an opportunity zone, and almost the entire island of Puerto Rico is also an opportunity zone. So So there's some opportunities to even take advantage of Act 20 and Act 22 as well, if you're feeling really, really feisty about avoiding taxes. This is one of those things, I love to hear people say that they are going to pursue complicated tax maneuvers on their own, and I wish you the best. This is not one of those things that you want to mess around with, because the penalties for screwing this up are astronomical. Talk to a tax professional that's got the liability insurance to cover you and knows what they're talking about. Don't just read an article on Bloomberg and think that you've got it figured out and just jump into a project.
Like you mentioned something about how you wish the bull run had gone longer. Was this not announced until like February or something like last year? Or what was the timing?
So they announced it in September, and you can go back and you can actually amend your returns if you were lucky enough to fall into this. The problem is, even with all the tax law updates, there still wasn't clarification for, okay, well, how do we actually calculate percentages out? When does the 180 days actually start? Those have been trickling out here and there, and there have been 3 or 4 different updates now on the specifics of the ruling. So most people have avoided this because it's so specifically nuanced that if you don't have those rules, you can't actually engage in it. But if you got lucky enough to invest, so there's a apartment complex being built on the very southern end of the QOZ in Longmont that they bought real estate, that the ruling for real estate is it's 100% of the building value does not factor in the land value. So if the building value is 0, because there is no building, it's just a field, being able to build an apartment complex on there, even spending $1, you're now in compliance with QOZ rules. So now they're building up this apartment complex, and I hope to God the investors that invested in that had capital gains 180 days or sooner before they invested in this project, because they'd actually be able to defer their gains through qualified opportunity zone. But they would have stumbled into that. I'm willing to bet that they didn't do that with intentionality.
That's interesting.
Yep. Which also means there's going to be a huge sell-off, probably around 2026, for people that didn't have enough cash flow to cover their capital gains and are either in businesses that aren't cash flowing the way that they hoped, or they can't borrow against, that are illiquid, that are going to have this massive tax bill. So if you don't want to get involved in this now, keep your powder dry and be prepared for a lot of buying opportunities of real estate and businesses all over the place. So
What's it again?
2026.
I'll be ready.
If anyone wants to sign up for the email list, we'll keep a best of the worst.
I'll be ready.
So I don't know if you guys are Twitter junkies like I am. As of yesterday, John McAfee announced via Twitter video that he is under a grand jury indictment from an IRS tax court in Tennessee for, he alleges he doesn't know what it is, but he's been taunting the IRS for the last month, saying that he's not filed a tax return in the last 8 years. He has been domiciled in the US here and there. He's also been receiving tokens for shilling different coins and projects, so he's got clear income, but it says he will not file a return and is objecting, and has documented video proof of him saying this. If you're going to do things that are illegal, or you're going to do things that are questionably legal or in a gray area, the easiest way to not get in trouble for it right off the top and have at least some plausible deniability that it wasn't a criminal act is to not be like John. Do not go online. Do not, tout your prowess when you're deliberately flouting the law. I don't think anyone is really enthused about paying taxes. I think we all would like projects that, the government pays a bunch of money into to not exist. I think that's red, white, blue, green in between. But just being that flagrant about it, you're going to have a target on your back. Now, I have filed a Freedom of Information Act request to see if I can get a copy of the docket to see what they're actually charging him with, because this is actually going to set a precedent for a lot of people who have deliberately not filed their cryptocurrency taxes. John has, and I'm kind of making some assumptions here, if you're at the point of having a grand jury indict you, you've probably missed a lot of the notices. You probably haven't gone through the administrative cure options. You don't have to go to tax court to get right with the IRS. So if you do have cryptocurrencies that you've not paid taxes on that you're concerned about, we can always go back and file those returns. It's a lot better to be pushing and controlling the narrative with you supplying the information instead of the IRS coming back and saying, we think you traded $100,000 worth of Bitcoin. The onus is on you to prove otherwise. It's a lot easier to push things through ahead of time instead of waiting for them to come serve you an indictment, because I don't think most of us want to sail a boat down to Venezuela and pray to God that the new president of Venezuela, when he takes power, isn't going to extradite you back to the United States. So on that note, if you have any questions, I'm happy to answer. This is all my contact information. This QR code actually goes to a list of resources on our website. I've got a couple different Excel spreadsheets and things like that. If you don't want to pay for, Bitcoin.tax, CoinTracker.io, and you only have a handful of transactions, it's a really great place to go. Our website has a ton of musings on different tax topics. I wrote one on QOZs, I wrote one on loss harvesting and some do's and don'ts, and I actually wrote one on the 4chan Crusade thought audit and what that actually means for crypto shills on Twitter and how much easier it is to actually report someone on crypto Twitter and actually have their case go through than it is to just go after Instagram models. So things to think about if you're shilling coins. So if you have any questions, I'm happy to answer them now. If you don't want them recorded, like was said earlier, we can talk about them over at the bar after the event. So. Yeah.
I use Bitcoin.tax pretty religiously.
Yes.
And so when there was a lot of gains, I used a certain, what's the classification on like LIFO or FIFO? And you can,
Right.
It gives you the ability to kind of choose what you want to do. My understanding is like once you pick one of those, you're supposed to stick to it.
So you stick to it for the year for that specific asset class. So
Okay.
because we're not securities, in the most full sense of the word, and this is where we start to, we talk about kind of shades of gray within the tax code because we only have that one notice. Because we're not securities, we're allowed to pick literally any accounting method short of cost averaging, because cost averaging is specifically for securities and mutual funds. But you can do first in, first out, FIFO, last in, first out, LIFO, specific identification, highest price first out, first or closest first out, and you can play around with that. Once you get through that tax filing year, as long as you maintain the tokens that have kind of carried over in your portfolio, that basis, you can then switch from FIFO in year 2017 to LIFO in 2018. So you do want to play around, and I love Bitcoin.tax. It's one of the ones that I use because they've got account access that I can just jump in and pull your records without you sending a bunch of exchange information or APIs or anything like that. It's not a perfect system. Make sure you check the numbers. Sometimes it doubles up on the information. Sometimes they do updates and things get lost. I always go through it with a fine-tooth comb. But play around with those numbers. And that's where the short-term versus long-term can make a difference.
Yeah,
Exactly.
I just wasn't sure that I could change. I thought I had to
You-
stick with one.
Right. So once you file that return, it's locked in for that year unless you're going to go back and amend the return.
So that's interesting. My understanding was that if you wanted to use something like specific identification, you would have to be able to prove and go back that certain coins that you bought at some date are actually the ones that you sold on X date if you did them along the way, which is a bit more difficult than just doing.
Yeah.
Right. But on the flip side, they have to prove that those coins weren't there as well. So I think we'll get to a point, especially, and this is why we see this in traditional stock brokerages, is we're not moving shares of stock typically from one exchange or one brokerage to another, and that's why they lock the accounting period in with those exchanges. It's kind of like stock was, I think, before 2005, where you were relied on to disclose that. The IRS probably isn't going to begin. Knock on wood. Don't ever take anything I say as 100% gospel. The amount of abuse that's already happening in the crypto space around tax evasion, they're going to go for the lowest hanging fruit. The John McAfees that are deliberately flouting the law. The onus for them to go through and have to prove documentation wise that those coins are not those coins is going to be too high for them to actually go after that consistently.
Okay. And so the reason why in crypto you can flip-flop however you want per year between the different accounting methods is because it's not like a stock or a bond?
Correct. And that's why wash sale rules typically don't apply to crypto as well. And that's another one of those 95% confidence ratios. I have no issues with wash sale rules if you wanted to be perfectly safe. So if you were at the end of the year and said, man, I want to jump out of Ethereum and lock in my capital losses and then jump back in. If you want to be 100% perfectly safe, wait 31 days before you jump back into Ethereum. A lot of people switch from Ethereum into a stable coin, let things fall down a little bit more and then buy back in. But you want to start looking at economic substance, but generally speaking, wash sale rules wouldn't apply to cryptocurrency because once again, the onus is on the IRS to figure out what was done where. Yes?
Does trading on a platform like Coinbase make you low-hanging fruit?
Not necessarily. If you're not disclosing that you've got trades on Coinbase, yes. So they lost that lawsuit back in 2017 that covered 13, 14, and 15, I believe. And they had to basically disclose, hey, John Doe traded at least $20,000 worth of crypto on our platform. And that's not $20,000 of profit. That's, I bought a $5,000 chunk, I sold a $5,000 chunk, I bought a $5,000 chunk, same chunk. You might actually have a loss, but now they have to report with a 1099-K to the IRS that there was transactions happening on the platform just like PayPal.
So they're already submitting a document when you already have
Correct, just like a 1099 or a W-2, your employer will submit a copy to the IRS, and that's how the IRS knows who's not paying their taxes and who has a liability without doing a full-blown audit.
So they're submitting those documents.
Not all exchanges, but most of the US-based exchanges, after that lawsuit was lost, have just kind of fallen in line with that because that's the new compliance standard.
So pretty sort of easily traceable.
If you've ever had any point where fiat dollars from a bank account have touched an exchange, you're already on the grid to a certain degree, unless you are back alley buying Bitcoin for cash, and even still, it's kind of like the Walter White. If you're going to have a bunch of fancy new cars and show $2 worth of income without being able to prove it, they're going to figure out and put two and two together that you're illegally trading Bitcoin. The other thing too is because Bitcoin is immutable and it's a public ledger, it's not really great for doing criminal activity. So the more that it hits a bank account or is trackable, you're pretty much on the radar. But if you have significant amounts of transactions on Coinbase or GDAX and you're not claiming it, you're going to be the easiest target of all because they know that you're supposed to have it and you're not showing it.
What if you're just buying?
If you buy and it's fiat to crypto and you're buying and holding, there's no taxable event. It's only
You're not filing anything, right?
correct. There's nothing to file unless you are buying in fiat. So you go on vacation and somehow you're able to buy. You put fiat into Binance, you buy on Binance, and you've got more than $10,000 a year of crypto held on an exchange in Binance, and it's technically in Malta. You'll have to disclose on an FBAR form that you've got foreign assets, but there's no taxable events.
Hypothetically.
Are you sure you want to ask this while this is recording?
Nah.
Okay.
I think you
Yes.
kind of explained this with wash sales. So if it was like 24 hours or any period below 31 days, what was the rule again?
So generally speaking, if you're doing, so let's say you bought a share of Ford
Yeah.
and you sold that share of Ford and then you bought it back 24 hours later, the IRS would rule that the losses that you tried to harvest there are null and void. You wouldn't get the benefit of that. With crypto, if you're trading from coin to coin and we can prove that, hey, you bought Litecoin because it goes to another exchange faster, there's an economic reason for doing that. Once again, 95% confidence ratio, the wash sale rules won't apply there. You can still harvest that loss, even if you take that Litecoin and you go back and you buy Ethereum on another exchange. Sure.
Since the tax law is so vague and open to interpretation, does the IRS kind of expect people to interpret it differently?
No, I think they've got kind of their own idea with capital gains. It's that part's pretty straightforward. I think where they're going to get into a battle is issues like Litecoin exchange. If you have inconsistencies on how you're valuing your Bitcoin, well, if you buy it on Binance but you're using, Cryptopia's price for Bitcoin, which is way lower because there's no liquidity, and you're kind of picking and choosing without having a rhyme or reason or consistency, that's where people are going to get into trouble. And this is probably a little bit of a jaded tax professional's opinion. In my opinion, there are things that are pretty cut and dry of how we need to handle this. There's really not a lot of wiggle room there. I don't think the IRS is going to see that. And the couple notices that they've put out about, hey, enforcement's coming. So they have their top 5 list every year of, these are the 5 things that we're going to enforce. Number 3 was, they call them virtual currencies for any kind of cryptos. Number 3 with a bullet was, we're coming after virtual currencies. And the very last paragraph said, at this time, there's no amnesty program on the table for those that have not, filed in good faith.
It's a good thing the government shut down.
Means nothing, because in 6 days, IRS is back to full strength.
No, you-
Because they all
you don't
become
have
necessary.
Cobalt running mainframes nowadays. They actually have real computer systems that actually.
No, it's probably still Cobalt. That's the only thing that still works right now. So I can still file for EINs. I can set up installment agreements online. But if I call to check, a client, they're cashing checks that get sent into them for payments. But if you call to actually make sure that your check was applied to your account correctly, there's no one there to pick up the phone. So, and that's the other thing too. The commissioner of the IRS has signed a letter to Congress saying that the deadline or the tax season turnaround times, which is usually about 2 weeks for refunds without any kind of hiccups,
2 months.
are going, well, he's claiming that they're not going to be changed. I'm taking action right now if anyone wants to bet over under on the 2-week deadline, whether or not they're going to get that, because it's going to be a political nightmare. And the funny thing too, kind of on a tangent, it's amazing the amount of power that Congress actually has over the IRS, because they're the one that writes the laws. So if you ever have issues with the IRS and you can't get things moved through, sometimes contacting your local representative and talking to the right person at their office, and then go talk to somebody at the IRS can actually speed things along. So where there's a will and a well-crafted plan within the confines of the law, and the other thing that people don't realize is the IRS, their entire handbook of how they do audit standards, how they have to operate in collection hearings, how they handle grand jury indictments. I was up till 2 a.m. flipping through all the procedures just to see how bad John got himself kind of wedged in a corner. If you could have an opponent that you knew their entire rule book and know that if they deviate from any of those rules, you can throw that book back in their face to your advantage, you would play that opponent 10 times out of 10. That's what the IRS is. They have a defined set of rules that come from Congress that they cannot deviate on. They can give clarifications on how they're going to handle that, but there's always some sort of way to negotiate around that in certain situations, depending on how well you act in good faith and if you file the appropriate paperwork.
So I have a question.
Yeah.
So, basically cryptocurrencies, as we're aware of, perform different functions within different contexts.
Mhm.
So, that's obvious to us.
Right.
And so, from what I'm understanding, they're basically just lumping up into one sum called capital gain.
Correct.
So they're calling it necessarily, I guess, an asset, right? So it's a
Right.
general term, asset.
Correct.
And then, so I was wondering, are they gonna contextualize it maybe in the future? Like, because I think there's,
You know,
if they do bucket it like they're doing now,
Right.
then that would basically be unfair in comparison to convention today. So
Certainly.
For instance, the forex market, how do they treat forex?
so currency is a completely different tax structure.
That's what I'm saying.
Right.
That's-
So if we were using crypto like fiat and it's a stable coin, then we could make that argument for sure. I think the issue is crypto is such a square peg that we are trying to cram into regulatory tiny round holes that unless we are going to start really lobbying and pushing, and I think it's going to come more at a state level than it will at a federal level,
When
kind of like
actually
marijuana.
They would have to contextualize it, no?
You would hope so. I mean, we're talking about the government here. So
Yeah.
this was all born out of,
That's why I'm leaning on you, brother.
anarcho-capitalist
Tell me
roots,
what's
so
going
it's very interesting to watch the hardcore people that want to tear down the financial system now having to learn about like-kind exchange rules and actually caring about capital gains tax
on. We're
and having to balance it.
heading more into that direction every day.
I'm personally still pushing, let's tear down democracy. You can install me as a benevolent dictator. It'll be a crypto meritocracy. We'll have favorable tax laws on crypto, but we're going to have to make some sacrifices. So honestly, I think truly the best thing that we can do right now, so there's the Governor's Blockchain Council. There's a lot of people here in Colorado that are making a really big push for getting clarification, getting the state to kind of back us so we can start doing and building and growing more. That's going to be the best spot for our voices right now. And the more that we band together, the more that we get involved in meetups and show that, it's not there's dozens of us we demand to be taken seriously, the more that we're actually going to get favorable legislation pushed through. Because Wyoming right now is jockeying to be crypto capital of the United States. They can bring high-paying tech jobs into Wyoming where there's no state income tax and they've got favorable securities laws that will protect projects. Why would you be in California where you're going to be paying at least 13% on any major company? You've got all these different rules and regulations and they're not really that friendly to business. Countries are going to start fighting for it. The Bahamas is still a really great option because there's 0% corporate income tax there, but we still have a lot of structuring that we have to do depending on where that income is being derived from and how we're handling the transfer of funds as well. So, like I said, that's what we do, not just tax preparation. We do a lot of structuring to help our clients save significant amounts of money depending on what their situation dictates and necessitates. So, yeah. Any other questions?
So you would, if someone came to you with, a business plan, the stock advice I hear a lot of times is you want to file as an S corp in Delaware, right? But if you're a crypto company, you want.
So it just depends.
Yeah.
If you're a company that is taking crypto as payment, if you're not going to have nexus outside economic nexus of you're operating in this state and the bulk of your clients are in this state and you're providing, say, tax services. I'm a Colorado LLC filing as a subchapter S corp because there's tax advantages to doing that. Depending on the dollar amount, if we start scaling up, all of a sudden it might make sense to have a C corp that manages the S corp, and that S corp becomes a truly passive organization. Delaware was really picked because you can vote by proxy. So if you've got shareholders all over the country, everyone can electronically vote at the shareholder meetings. Delaware used to be a pretty good spot to go. If you were doing a C corp that you were trying to have acquired at some point, probably looking at a C corp not an LLC, not an LLC designated as a C corp. But that's going to be completely dependent on what your goals are, what your exit strategy is, what your income is derived from, and how you're planning on operating. Do you have partners that are here? Do you have partners all over the country?
And
How
if
much are
you're
you
looking for
expecting?
Funding, you're not gonna be able to do anything else, I think.
Well, and so I mean, even with S corps, you can have investors, but you can only have 100 shareholders.
Like VCs wanna see that.
Right, and
They
usually,
have more protections.
usually people that get themselves into trouble form some sort of entity type, and they don't understand the tax structure, number one. And number two, they go to get acquired, and they have to go back and unwind all of the S corp and convert it to a C corp, which is then more legal process, and there's some potential taxation issues as well, depending on how that's all handled. So that's a really good it depends question.
Is there any world where like a crypto native company would not have to incorporate?
I mean, you can take crypto as an individual. You don't have to incorporate. The benefit to incorporation from, if you're issuing tokens, liability is the big one, and
Is there
also
any way to get around the liability? Or
C,
any other?
C corp or hold it in a trust. But even still, depending on the type of trust, you can have liability issues as well. It just depends on where are you deriving the benefit and the income from. What do you actually need to be coming to you to take care of your expenses, and who's involved as far as the ownership of it. There's a lot of talk about the idea of DAOs, and I love the idea of DAOs. It's going to probably look more like a cooperative LLC based model, but there's no real framework right now for. No one actually owns this thing; it just kind of exists. But we need some sort of custodian to pay, certain registration fees or to be responsible if, I'm sure a senator probably thinks a DAO could go rogue and kill a person or not file their payroll taxes. There's certain things that have to be worked out because once again, the technology is way outpaced any part of the legal or, tax side of things.
Poke on that.
Yeah.
I have a question about that. So if you're not touching fiat within that DAO, right? And it's just basically a crypto economy.
Okay.
If you're not touching fiat, then really, do you need to create a legal entity for that?
That's what I'm saying. That's what I was
So the question is, who owns the wallet address? Are you taking payments into the DAO at all, or is it just I'm pushing these tokens
Oh,
out?
sure, yeah. I mean, it's actually a functioning agent, but it's
If-
not touching a bank. It doesn't need to-
Even with not, you can trade crypto to crypto and never pull it out the fiat, and there's still taxable events there. The act of receiving crypto for goods and
So
services
as soon as you're-
necessitates income tax.
if you're
Yep.
interfacing with tax.
Correct.
IRS,
And then the idea would be then you'd want to form a company or a structure that the
That
taxes don't bleed
sucks.
through to the shareholders.
Yeah, well, because it seems like it's like when you found a company, the reasons you would set up an entity are one, the liability, and two, you need a bank account.
Right.
So if you don't need a bank account anymore, and you're not liable because it's the DAO operating, why do you need? an entity?
But if the DAO is receiving money,
Yeah.
who owns the DAO? Even if no one owns the DAO,
What can
who
IRS
start?
do?
But it's the same thing that was so Silk Road. So if you create a website and get a website up,
Yeah.
they can still come after you for being the one that created the website if it creates harm. I'm not saying that that's right or just or makes any
So
iota of
become
sense.
Satoshis and do it anonymous.
Burn off your fingerprints, move to the Freedom Boat, and just be anchored off of Venezuela.
But
If-
that's how we can do
Yeah, there you go.
But I mean,
You just have to be
once
Satoshi.
again, going back and really pushing for the legal structures. LLCs are all based on a state level. They're relatively new. I mean, it's the 90s, I think, was when LLCs really kind of came into prominence. Every state was determining their rules. Push for Colorado to come up with rules and regs for DAOs. Who actually owns this? How do we structure this? What's the taxation? Call up your reps and demand action.
it.
It's
Did they
holding us
talk
back.
about that at all? Do you know within the legislative council and stuff?
So, as one of the people that sat down in the meeting, I'll tell you at the bar my real thoughts and feelings on that. It's going to take a lot of time and a lot of effort, and it's going to have to come from the legislative side. The revenue departments will not create law. They can't. They're there to administer the law. So we have to partner with them to get them on board to understand, one, what's going on, and two, we have to get the legislators to actually sign laws into effect saying this is our revenue code for the state level.
Okay, so you're talking generally, or are we talking about the DAO portion of that?
Yes.
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 Thank you
To
for your
both.
answers.
As clear as mud. It's one of those things, so we have to push for the legislation specifically for that to get
But
clarification.
doesn't that look good right now? I mean, I thought we already had kind of a bill and we actually almost got it passed, and now
Right.
we've got a lot of work.
So there's
Wyoming's
not-
had a lot of work, and
There's nothing on the
now
table right now for
legislative-
DAOs.
We got a new governor, and
Yeah.
everything's looking good, so yes, it's gonna pass, and everything's gonna be hunky-dory.
I'm the wrong person to ask. I'm just here to answer tax questions.
I figured you had more insight than I did, so.
So, Awesome. Anybody else? Any other questions?
Thanks,
Cool.
Andrew.
Yeah.
Awesome. Well, thank you so much, Drew, for that awesome information. And